Let's understand value at risk (VaR) in a way that's easy to grasp. What is value at risk VaR? Value at risk, or VaR, is a way to measure how much money you could lose on an investment or a portfolio over a specific period of time, given normal market conditions, and with a certain level of confidence. It tells you the worst-case scenario for your investment over that period, with a certain degree of certainty. How does VaR work? Time period. Decide how long you want to look into the future, like 1 day, 1 month, or 1 year. Confidence level. Choose how sure you want to be about the worst-case scenario, like 95% or 99%. Potential loss. Calculate the maximum amount you could lose within that time period at the chosen confidence level. Practical examples. Example 1. Saving money for a new phone. Imagine you've been saving up to buy a new phone, and you've invested your money in stocks. You want to know how much you might lose in 1 month with 95% confidence. Time period, 1 month. Confidence level, 95%. Let's say your VaR calculation shows that with 95% confidence, the most you could lose is $50 in 1 month. This means there is only a 5% chance you could lose more than $50 in that month. Example 2. A lemonade stand business. You run a lemonade stand and want to know the risk of losing money over a week. You keep track of your earnings and costs every week and want to make sure you don't lose more than a certain amount. With 99% confidence. Time period, 1 week. Confidence level, 99%. After doing some calculations, you find that with 99% confidence, you won't lose more than $10 in any given week. This means there's only a 1% chance you could lose more than $10 in a week. Why is VaR useful? VaR helps you understand the risk of losing money on an investment. By knowing the worst-case scenario with a certain level of confidence, you can make better decisions about how to manage your investments or business. Real-world application. Banking. Banks use VaR to understand the risk of their investment portfolios and to make sure they have enough money in reserve to cover potential losses. Investing. Investors use VaR to decide how much money to put into different stocks or bonds and to manage the risk of their portfolios. Businesses use VaR to understand the risks involved in new projects or investments and to plan for potential losses. Simple explanation. Think of VaR like this. Imagine you're about to go on a road trip. You want to know the worst weather conditions you might face with 95% certainty. If the weather forecast says there's a 95% chance it won't rain more than 2 inches, you prepare for that amount of rain, knowing that the chances of facing worse conditions are very low. Similarly, VaR helps you prepare for the worst financial weather you might face with a certain level of confidence, helping you manage your money more wisely.